What if the real danger to the global economy isn't inflation, recession, or even government debt, but a financial shadow world 6 times bigger than everything America produces in a year? A world so tangled and opaque that even the people who created it can't fully explain it. You may think 2008 was the worst financial disaster of our lifetime, but here's the truth. The fuse for something even larger was never removed. It was only buried deeper. To understand how a $600 trillion time bomb was built, we need to go back to a moment that looked harmless, even boring. Imagine the early 1980s Wall Street trading floors. No flashy screens, no high-frequency algorithms. Just phones, paper, and a radical idea beginning to whisper through the halls. What if you could trade risk itself? Banks and corporations had always faced dangers. Interest rates moving the wrong way, currencies fluctuating, loans going bad. But until then, risk was like weather. You couldn't sell your storm clouds to someone else. That changed with the rise of derivatives, contracts whose value came from something else. At first, they acted like insurance, but by the 1990s, insurance had morphed into a casino. Here's the twist. Derivatives weren't inherently evil. In small doses, they smoothed out uncertainty, just like a seatbelt makes driving safer. But add too many seatbelts, too many straps, too many gadgets, and suddenly the driver can't move, and the crash becomes far deadlier. By the time the dot-com bubble burst, derivatives had grown into something no regulator fully understood. Banks were layering contracts on top of contracts, multiplying risk instead of reducing it. And yet, almost no one noticed. Why? Because the system seemed to work. Losses disappeared on paper, profits grew. Politicians saw innovation and stepped aside. After all, who wants to be the person who slows down a booming economy? But wait, that's not even the shocking part. As derivatives ballooned, they created invisible connections between banks that were supposed to be independent. A failure in Tokyo could hurt a fund in New York. A mistake in London could rattle mortgages in Phoenix. Think of it like stacking 10,000 dominoes around the planet. On their own, they're harmless. But once the circle closes, knocking over one means knocking over all. Fast forward to the early 2000s. Housing prices looked unstoppable. Borrowers with shaky credit got loans they could never repay. But banks weren't worried, because they could bundle these risky mortgages and sell the danger to someone else. Credit default swaps, basically bets on whether loans would fail, exploded in popularity. Once again, risk was being passed along like a hot potato. And once again, no one really knew where it ended up. You know what came next. The summer of 2007, Bear Stearns, Lehman Brothers, the global freeze. The moment the world discovered that derivatives, once meant to protect the financial system, had turned into gasoline poured over a flickering flame. But here's the part most people missed. After the crisis, regulators didn't shrink the derivatives market. They didn't dismantle the structures that nearly collapsed the world economy. Instead, the system became even more concentrated. Fewer banks controlled more contracts. More trades moved into the lightly regulated over-the-counter market. And the total size of derivatives? It kept growing. Today, estimates hover around $600 trillion, almost too large to comprehend. Picture every dollar bill the U.S. has ever printed. Now multiply that mountain over and over until you've built a financial Everest. That's the scale we're dealing with. If that makes you uneasy, it should. Because here's the cliffhanger nobody wants to talk about. In a world more interconnected than ever, politically, technologically, and financially, could the next spark spread even faster than in 2008? Could a single miscalculation, a single bankruptcy, a single geopolitical shock unleash a chain reaction that regulators can't stop? And if so, where would it start? To trace the next possible ignition point, we need to examine the places where risk hides best. Quiet corners of finance, where complexity acts like camouflage. One of those corners is the modern interest rate swap market. It sounds technical, but think of it like this. Two parties shake hands and agree to trade their versions of the future. One bets rates will move up. The other bets they'll stay flat. Both can't be right. Now imagine millions of these agreements layered across every major bank, pension fund, and insurance company on the planet. If interest rates suddenly lurch in one direction, a shock from the Federal Reserve, a political crisis, a slowdown in China, those bets can swing wildly out of balance. And here's the uncomfortable truth. Many institutions don't keep enough cash on hand to cover the sudden losses. They rely on the assumption that markets stay calm. But you and I both know markets don't stay calm forever. Take 2022 and 2023, when central banks raised rates at the fastest pace in decades. Governments had borrowed heavily during the pandemic, locking in so-called low-risk positions through derivatives. Everything looked fine on spreadsheets, until those swaps suddenly required enormous collateral calls. The United Kingdom saw it firsthand. Pension funds faced margin demands so large that the Bank of England had to step in to prevent a cascade. That was just one country, a glimpse of how quickly stress can ripple outward. But wait, there's another layer to this story. The biggest players in derivatives today aren't just banks. They're also shadow institutions, hedge funds, private investment firms, fast-moving trading desks that operate outside traditional regulatory frameworks. These firms use borrowed money, sometimes extreme levels of leverage, to amplify small opportunities. It works beautifully in calm markets. In a storm, though, leverage becomes an anchor pulling them underwater. Remember the collapse of long-term capital management in 1998? A hedge fund run by Nobel Prize-winning economists nearly brought down the global system because it layered massive bets on top of tiny price differences. It took a coordinated rescue by major U.S. banks to stop the bleeding. And that was with a derivatives market a fraction of today's size. Now picture that same scenario multiplied by thousands of hedge funds managing trillions in borrowed positions. They trade quickly, they react instantly, and if one of them falters, lenders yank funding, positions unwind, and the selling begins. That forced selling can spill into stocks, bonds, commodities, every market you can name. All it takes is one highly leveraged domino tipping in the wrong direction. But here's the twist most viewers never hear. Many of the contracts in this $600 trillion world are linked to each other through clearinghouses, the institutions designed to reduce risk. Clearinghouses act like referees. They make sure both sides of a trade are honored, but as they've grown larger, they've also become single points of failure. If a clearinghouse takes on too much exposure and can't meet its obligations, the impact would be immediate and global. So, the question becomes, how much strain can these systems handle before something snaps? Consider how often we hear the phrase, too big to fail. In 2008, it referred to banks. Today, it might apply to clearinghouses themselves. Here's where things get even more unsettling. Unlike stocks, bonds, or real estate, many derivatives don't have transparent prices. Their value depends on mathematical models and assumptions. When markets become volatile, those assumptions can break. That means institutions might believe they're protected, until the moment they try to unwind their positions and discover the numbers don't hold. And that brings us to the newest accelerant: geopolitical uncertainty. Conflicts, trade tensions, cyber attacks. Each one can trigger abrupt changes in interest rates, currency values, and commodity prices. Because derivatives are intertwined with all of these, geopolitical shocks can spread through the system faster than ever. Imagine the economic equivalent of a lightning strike traveling through a web of copper wires. At this point, you might be wondering, if the risks are so huge, why hasn't the system collapsed already? The answer is deceptively simple. It's the same reason a neglected bridge doesn't fall the first time a truck crosses it. Stress builds slowly. Cracks widen quietly, the structure holds, until the moment it doesn't. And here's a quick pause. Leave a comment. What was the most important lesson for you so far? The one connection you'd never noticed before? Because the next part of this story dives into the heart of the danger, how everyday people, homeowners, workers, consumers, could feel the shockwaves long before politicians or bankers admit a crisis is brewing. What happens when the derivatives world collides with the real economy? When a derivatives crisis spills into the real world, it doesn't begin with headlines. It begins with pressure points. Quiet, invisible, and ordinary. A company suddenly faces higher borrowing costs. A bank tightens its lending standards. A municipal government postpones a road project because its interest rate swaps turned against it. None of these events scream crisis on their own, but together they form a pattern. Credit slows, confidence weakens, and everyday life becomes just a little harder. This is how 2008 started too. Before Lehman collapsed, before markets froze, families were already feeling the squeeze. Today, the same dynamics are forming again, only larger and more interconnected. Because when a derivatives contract blows up, someone must pay. That someone could be a pension fund managing retirements, a local bank funding small businesses, or a corporation that employs thousands. Take the example of commodity derivatives. Companies use them to lock in prices for essentials like fuel, wheat, and metals. But when prices swing violently, whether from war, drought, or supply chain shocks, these contracts can generate sudden losses. A utility company might be forced to raise rates. A manufacturer might freeze hiring. And consumers, already stretched thin, tighten their budgets further. The ripple effect widens. But wait, there's a deeper problem hiding beneath all of this. Much of the $600 trillion market is built on assumptions about liquidity, the idea that buyers and sellers will always be available. In calm markets, that's true. But in moments of fear, liquidity can vanish instantly. Think of it like trying to sell a house during a hurricane. Technically, it's for sale, but no one is buying. During the early days of the pandemic, we saw how quickly markets can seize. Even U.S. Treasury bonds, supposedly the safest assets on Earth, went through periods when buyers disappeared. Central banks intervened aggressively, but the message was clear. The system's stability depends on constant support. Now, layer derivatives on top of that instability. If the underlying asset becomes hard to trade, the derivative tied to it becomes impossible to price. That forces institutions to post more collateral. More collateral triggers more selling, and more selling triggers more fear. It's a feedback loop that accelerates until someone, usually a central bank, steps in with emergency liquidity. But what if the shock is too large, too sudden, or hits too many markets at the same time? What if the next crisis isn't just mortgages or tech stocks, but a combination of interest rates, currencies, commodities, and geopolitical tensions all at once? That's when derivatives become a fuse connected to every corner of the global economy. Here's a case study that rarely gets the attention it deserves: the 2014 oil price crash. When oil plunged from over $100 to under $40, many energy companies had used derivatives to hedge their production. On paper, they were protected. But when banks demanded collateral for those plunging prices, several firms faced liquidity crises. Some laid off thousands. Some filed for bankruptcy. Investors took losses. Communities dependent on those industries felt the blow for years. That was just one commodity during one downturn in one sector. Now imagine bonds, currencies, and commodities all moving sharply at the same time. And there's another twist. Many derivatives are designed to work perfectly under normal conditions. But the world today is not normal. Supply chains are fragile. Trade routes are contested. Governments are more divided, more indebted, and more reactive. A cyber attack can disrupt payment networks instantly. A political crisis can send currencies into free fall overnight. All of these shocks feed directly into the derivatives ecosystem. Here's where the danger becomes personal. When financial institutions face sudden losses, their first instinct is to protect themselves. That means reducing credit lines, cutting loans, repricing mortgages, charging higher rates on credit cards. Even businesses with solid finances feel the squeeze, and ordinary households feel it next. Remember how quickly unemployment rose in 2008? That wasn't just because banks failed, it was because those failures choked the flow of credit. Employers had no choice but to pull back. The next crisis could unfold even faster, because today, algorithms, not humans, control massive portions of trading. They react in milliseconds, they amplify volatility, and once automated systems start selling, they don't stop until prices find equilibrium, which, in a panic, can be far below where fundamentals suggest. But here's the question hovering over all of this. If central banks intervened in 2008, 2020, and 2023 to stabilize markets, how much more can they do? Interest rates are already high. Government debt levels are already massive. The typical playbook, cut rates, buy bonds, flood the system with liquidity, may not work as effectively next time. Because what happens when the crisis isn't just a lack of liquidity, but a loss of trust in the entire structure? And that leads us to the final act. How this time bomb could detonate, what the first warning signs will look like, and why the next crash could be worse than 2008. Not because the system is weaker, but because it is bigger, faster, and more connected than at any point in history. The first warning sign won't be dramatic. It never is. It might be a mid-size foreign bank announcing unexpected trading losses, or a clearinghouse quietly adjusting margin requirements, or a hedge fund that suddenly stops withdrawals without explanation. These tremors appear small, footnotes on financial news tickers, but in a system wired tightly through $600 trillion in interconnected contracts, a tremor in one node can shake the entire web. Consider how the 2008 crisis began. It wasn't Lehman. It wasn't even Bear Stearns. It was two obscure hedge funds at a bank few consumers recognized. Their losses exposed weaknesses. Those weaknesses spread, confidence cracked, liquidity disappeared. Replace those mortgage-linked securities with today's colossal derivatives network, and the stakes rise exponentially. So, how could the next crash unfold? Picture interest rates spiking due to an unexpected geopolitical shock, maybe an energy supply disruption or a conflict that scrambles global trade routes. Suddenly, trillions in rate swaps swing violently out of balance. Institutions on the wrong side face immediate collateral calls. They scramble for cash. Banks tighten lending to protect themselves. Hedge funds, highly leveraged, dump assets to raise capital. Selling intensifies. Markets move sharply. Clearinghouses raise collateral requirements, forcing even more selling. The feedback loop accelerates. Within days, assets once considered stable, government bonds, major currencies, blue-chip stocks, begin fluctuating wildly. Consumers see retirement accounts drop. Companies face rising borrowing costs. Governments scramble to restore calm. But here's the twist. The system is larger and more complex than in 2008. Liquidity is thinner. Trust is more fragile. The safety nets are stretched. And central banks? They face a dilemma. Cut rates to stabilize markets, and inflation might flare. Raise rates to fight inflation, and financial institutions might break. Either choice carries risk. At this point, regulators would likely attempt targeted interventions, support for specific banks, emergency lending, expanded swap lines between countries. But the derivatives market is global. A problem in Europe can hit America. A shock in Asia can hit Europe. Lines blur. Problems leap across borders. This isn't speculation. It's the pattern we've seen repeatedly. 1998, 2000, 2008, 2020, 2023. Each crisis spreads faster than policymakers expect. Each one requires larger, more coordinated action. And each time, the tools become harder to use. But here's the part that matters most for ordinary people. A derivatives-driven crash doesn't look like a Wall Street failure. It feels like rising prices, disappearing jobs, frozen credit lines, and delayed paychecks. It's households paying more for mortgages. It's businesses canceling investments. It's cities postponing repairs and schools cutting budgets. The financial shock translates into daily struggle. The good news? Crises also reveal weaknesses and reveal opportunities to strengthen the system. Greater transparency, lower leverage, more resilient clearinghouses, better stress tests. These aren't abstract ideas. They're practical safeguards. But they require political will. And that's where the real challenge lies. Because derivatives generate profits. They fuel growth. They give institutions tools to manage risk, until they don't. And no government wants to slow an economy running on financial innovation. That tension is the core of the time bomb. We depend on a system we barely understand. So where does this leave us? In a moment of reckoning. Not one of fear, but of clarity. The next crash, if it comes, won't be a repeat of 2008. It will be shaped by new forces. Global supply fragility, geopolitical uncertainty, algorithmic trading, and dependence on a derivatives market whose size defies imagination. The lesson is simple. When a system grows faster than our ability to monitor it, risk doesn't disappear. It migrates, it hides, it gathers force, and eventually, it demands a price. Before we wrap up, take a moment and think back. What part of this story shifted your understanding the most? Leave a comment and let us know. And if you want more deep dive breakdowns that connect history, economics, and the forces shaping your life today, subscribe to receive more reviews like this.